Good morning and welcome everyone. I'm Amy French, head of Level 39, and it's my pleasure to welcome you to our virtual event this morning, Getting Investment Ready and How to Take Your Startup to the Next Level. And a special welcome to my panelists who will welcome to the stage and introduce shortly, Nick Lenz and Darko Atiez. The panel today is about how to scale your startup and specifically how to make the most of opportunities through investment and building relationships. For startups, especially in the early stage, navigating through the investment journey can feel overwhelming. We are regularly seeing data and statistics on the amount of investment going into the London tech sector. But for founders, demystifying the options out there, from accelerator programs to angel investors and VCs, and making the most of those opportunities requires careful consideration. Similarly, corporate engagement can be a game changer, but identifying the right relationships and making the most out of those partnerships can require guidance. For both, timing is always key, and ensuring you are investment ready can make all the difference. For this panel, we've brought together experts from the startup space to help make sense of it all, from preparing to embark on the investment journey and choosing the right route for you, to identifying the right investors and corporate engagement opportunities. So with this in mind, I would like to invite our guests onto the virtual stage. Welcome, Nick and Darko. Thank you so much for joining us. Hello. Hey, Nick as well. Brilliant. We're all here. Thank you so much for being here today. Really appreciate your time. So to kick us off, can I ask each of you to introduce yourselves, please? Perhaps Darko, can we start with you?
No worries. Pleased to meet you all. Darko Atiez, founder and managing director of True Altitude. We were founded as a corporate development digital commerce tech specialist, so focused on primarily importing foreign Silicon Valley-based supply chain tech companies into the UK. That's snowballed. We've invested in 20 companies and have raised more than 300 million in capital for our clients and investments, focused on software as a service, e-commerce, and fintech. Really pleased to be here today.
Thank you, Darko. And Nick.
Hello, everyone. Great to be here. So my background is in, my first career was in investment banking. I spent 20 odd years working in a corporate environment. Started with Morgan Stanley and then worked for UBS, and my latter engagement in banking was with Bank of America Merrill Lynch. But more relevant for this conversation, the last 4 years I've been involved in helping founders both prepare and attract capital into their ventures, so hopefully relevant for today's conversation. And I'm also a mentor at Level 39 and Barclays Rise.
Fantastic. Thank you both so much. And just a quick reminder to the audience. So the format of today, 45-minute panels discussion followed by Q&A. So do please feel free to put questions in the Q&A chat box to the right-hand side on the panel, and we'll get to those at the end. Wonderful. So to kick off this morning, I'd like to explore funding and investment readiness, as this is obviously a dominating priority for startups, and one that getting right is so important for growth and success. Nick, if you don't mind, we'll start with you. From your experience, as you mentioned, with startups both at Level 39 and others that you've worked with, what are the key signs that a startup is in fact investment ready?
Well, I think for me, one of the key starting points is having a really clear and well-defined go-to-market strategy. So this needs to be something that's very carefully thought through and well articulated and easy to grasp and understand to someone who doesn't necessarily operate in your sector. Ideally, having some early product market proof points. So demonstrating product market fit, I think is really beneficial. And that can be on a very small scale through some kind of testing or early proof of concept, or having some early stage traction or revenue. The other thing I would say is really key, which people often underestimate, is having really clear projections around what your ambitions and goals are and how that feeds into your financial projections. So I'd say those are, and obviously, you have to have a clear story that you can articulate through a pitch deck.
Brilliant. And so from your perspective, what are the most kind of frequently made mistakes perhaps that you see in the industry with entrepreneurs that are approaching, their first investment round?
So one of them is people tend to leave raising funds quite late and underestimate the amount of time and effort it requires to successfully raise. And that's why I think it's so important to think about, what does your next 6, 8, 12 months look like? And I would say allow yourself at least 4 to 6 months for a proper raise, particularly if you're exploring different funding venues. So, if that's angel or VC or crowdfund or a combination of. So I would say, leaving it too late, underestimating the time and effort required. And there seems to be a lot of focus on valuation. And I think that's sometimes a little bit misguided. We can maybe come back on that later, but that's something for me that doesn't require a great deal of thought or insight. It can be done quite relatively quickly.
And obviously, when a founder and a startup is starting to look for investment, Darko, we talked about the fact that you see a lot of pitch decks. Can you give advice to a startup founder on what they should include in their pitch deck, or things that you'd suggest to help them stand out? Are there kind of key do's and don'ts?
Yeah, sure. So I think first base principles, less is more. So often you see, 30, 60 slides, people get lost. So keep it fairly brief and punchy. Simplicity is king. Lots and lots of, particularly academic startups coming out of, deep tech R&D types of environments, they tend to overcomplicate what it is they're trying to solve. And most VCs or even early stage angel investors, even a sector specialist can get lost in very deep language. So keep it simple. Invest in design. So we're going to talk about remote networking and accessing people. And if you underinvest in the pitch deck, it becomes very apparent when people start sending it around. And as a base principle, we advise our investments and businesses that we've supported is make sure that it looks good on one of these things, because often what investors do is they'll forward pitch decks to each other, and if it doesn't look good on mobile, it probably won't get digested as well. And then at a minimum, in terms of the content, as I said, keep it fairly brief. You need to be able to articulate the problem that you're solving. Why is there a market, as Nick pointed out? Particularly larger investors like to tackle total addressable market and how the go-to-market is being addressed. Finance is important, so talking about runway, capital planning and dilution, any staff incentives. Keep in mind forecasting's more of an art form than a science. So rigor doesn't necessarily mean that you need to have a gun to your head the entire time, but certainly a bit of depth of thought is always well received. And lots and lots of acronyms, but the two things that I always try and tease out is the cost of customer acquisition, very, very important, particularly when considering marketing spend, and COGS. So many businesses don't actually investigate product level gross profitability. That's super, super important. And then the other key points are things like, of course, the team and the advisors that surround it. Any comparables and path to liquidity is very important to investors. And last but not least, the product. And then just to round that off, I'd say get feedback, keep testing, keep looping back around, and get your story straight.
Fantastic, thank you. Is there anything kind of that would be the standout feature of a pitch deck? Do you think anything that you've seen, you've thought, okay, that's unusual, but really good to see?
Not specifically. I think once people start doing demos and things like that, they become a bit too extensive. Really, simplicity is king. If you can get it if you can get it in 8 to 10 slides in a format that your nan can understand, it's probably probably a good way forward.
Brilliant. Okay, keep it simple. Good
Perhaps
one to
just to add on that, I think the common mistake I see on pitch decks is people try and tell you their full story. A pitch deck is not there to explain the be-all and end-all of your enterprise. It is there to serve as a teaser for someone like Darko or an investor to say, hey, this looks interesting. I get the concept. Yeah, I build it, I buy into the team on paper. Let's have a conversation. And that, for me, often people try and cram everything in there. And like Darko said, simplicity is key. Keep it really, really focused. And the other thing that I like to reference is, like, use your pitch deck and imagine that you're in a room of 5-year-olds, right? So 5-year-olds are easily distracted. They have short attention spans and they like shiny things. So how can you keep someone's attention whilst they read your pitch deck? That's, for me, is really, really key. If you have that mindset, that probably goes a long way.
Brilliant. Thank you, Nick. You mentioned earlier as well, about the kind of difference between angel investors and VCs, and the kind of pros and cons of working over them versus a VC. From your perspective, why might a startup seek to approach an angel investor versus a VC?
Yeah, so from my perspective, it really depends on the business and what their ambitions are and where they are at, most crucially, right? So many VCs will have very specific metrics that you need to demonstrate before they'll even have a conversation with you. And Darko can probably speak more about that. But so researching if you do think you're ready for a VC investment, really researching what that VC requires in terms of data points, in terms of traction, that's really, really important. Angel investors are a really important and an increasingly, I think, bigger part of the certainly very early stage investment community. And they have benefits. They can be very supportive of your business, perhaps a little bit less onerous than perhaps a VC might be. If you can find the right angels that bring business skills to your business as well as money, I think that's really, really valuable. And so doing your due diligence on angel investors, as you would with any investor, I think is really key. And then likewise, crowdfunding, has many advantages as well. It's not for everyone. I would say certainly for more D2C focused businesses, it can be an incredibly powerful kind of marketing and networking campaign.
Brilliant. And that point of kind of due diligence that a founder should do, well, I'll kind of come to that point in a moment as well. But coming to you, Darko, so what should a startup founder consider when deciding their best options for growth? So whether that's kind of direct investment, joining a program, what are your thoughts?
First thing, this is purely personal experience, so it is definitely subjective and skewed. I think there's been a massive overemphasis on seeking investment versus actually selling a product. So first things first, if you've got a good product, go out there and actually sell it. Prove that it can be sold. Don't just focus on simply investing. That also means you don't need to dilute. Second thing is considering, I've been mainly focused on B2B. So, B2C is a totally different bag. But certainly gearing your product for channel-led sales versus direct. Investors love products that are self-service, easy to enable through third parties, that makes them scalable. So when you're creating a product, particularly software or fintech or otherwise, looking to enable your channel partners to sell on your behalf. So don't want to overemphasize the fact that if you're creating a business from the get-go, you will find raising investment infinitely easier if you've got a very clear commercial strategy, first and foremost. For deep tech products, I'd say there's some other avenues when considering sort of commercial constructs. So for deep tech products, you'd consider IP licensing. So whether you have a holdings of IP, sub-licensing to third parties, that's probably a good avenue to go. And then in direct to consumer, we did a big piece of work with a non-alc spirit business called Liars. They changed strategies a couple of times through COVID, but certainly one of the attractive parts of Liars was initially they had very much a retail and a distribution-led model. They switched to direct-to-consumer. It ended up being far more profitable. So digital channels of sales for physical product can actually be a far more effective way of reaching market and commanding greater gross profitability. Back to the COGS point. And the other thing to consider is, and again, it depends on the maturity of the business at the time of raising money, is the mix of the amount of investment required in R&D versus sales and marketing. For more mature products at later stages, an investor would expect the vast majority of funds to be deployed towards sales, marketing, actual expansion versus earlier stage and less gestated options.
Brilliant, thank you. And Nick, coming back to your point on due diligence, when you're advising startups on investment, is there an amount of kind of research or due diligence that you suggest a founder to do on an investment or investor or a firm prior to engaging?
Yeah, absolutely. I think it's absolutely critical, and this comes through very early in conversations with those angels or VCs or any investor for that matter. You really need to do your homework. You need to try and network as much as possible and make sure that you understand what is it that particular investor is looking for, right? So what are the key hooks that you can play into? And the more research you do, the better. If you can find someone, for example, if you're wanting to connect with a VC, if you have a look at their portfolio and maybe you know someone who works in one of the portfolio companies, having a conversation with them and getting a really good understanding of the VC and what they're looking for is super important. I would say actually the advent of COVID has, to an extent, made that kind of initial engagement and transparency with VCs, I think, easier than it has ever been. Like the number of calls and networking events, pitch events that I am able to attend now, it's like, the access is I would argue, now easier than before. But that doesn't mean that you, in fact, the opposite. It requires you to really do your homework on, who's it you're speaking to and what are they looking for.
And then when a company does get investment, what are the biggest changes that a founding team will go through once they're kind of on that investment journey?
Yeah, so I would say you're accountable, right? From that point on, it's not just you and your sweat equity or you and your co-founders. You then become accountable to a third party, that's your cap table. And just respecting those investors, I think, is absolutely key. Again, understanding what their motivations for investing in you are, so you have very aligned goals, is super key. And that even comes before the actual investment closes. And for me, communication is absolutely essential. Like when things go wrong, and I'm sure Darko has many experiences of this, you need to be able to communicate to your investors and come up with a way to plan for a different outcome, pivot the business. Things will go wrong. That's absolutely inevitable. It's how you communicate and be on the front foot that's key, I think.
And Darko, coming to you, so a founder may be cautious about perhaps losing an element of control of their business on taking investment. What can they do to kind of manage this and manage the expectations with investors?
Sure. So I think early versus late stage is the key difference here. So if you look at angels or the vast majority of EIS funds, for example, in the UK, the control question microphone was off. My apologies. I was saying with angels or early stage EIS investors, control is much less of an issue. The terms tend to be far more vanilla. You know, you can have simple, ordinary shares and votes. No necessary need for any type of board reconstruction. Once you start getting into later stage investors, larger checks, they do start tending to demand some more exotic terms. And this is where the balance between value and control becomes fairly critical, and a bit of navel gazing is required. So by value, I mean the typical focus on raising investment funds is the valuation of the company. But what many founders don't realize is the underlying caveats and terms that come with that. And some good examples of that would be, for example, board voting rights and governance. You know, the really, really exciting stuff in a business that people forget about, i.e. when you can't make decisions without the approval of those investors. And that could mean things like hiring staff, raising additional investment, who you exit to. Second thing is these wonderful things called liquidation preferences. So a term in a typical sort of Series A term sheet would be a one-time liquidation preference. Participating or non-participating, but we won't get into that, which would mean that the investor that's putting the money in actually gets first dibs on money out when any type of exit happens, and that can have huge implications in the cap table. So those types of considerations, and very simply put, expectations on growth and voting rights. So if you're selling a plan to an investor, ultimately, you know, the level of oversight they're going to have over a business as a part of a large portfolio is they'll typically turn up to a board meeting once a month with some potentially lofty suggestions around what you should be doing with your business, but ultimately they're expecting the plan that you've sold them. So if there is underperformance, just to echo what Nick said, there is an onus on a business that's taken investment to over communicate and to comply with the requirements of what the fund needs in terms of reporting, and being very transparent around that. So ultimately, just to loop back around, it comes down to that point of value versus control. So what type of money are you willing to take for what loss of control, and read the fine print.
Brilliant.
Yeah, perhaps just to add to that, because I think it's a really important point that Dark has brought up in terms of the legals and some of the terms in these term sheets. Like, you know, not all founders, in fact, most probably are not, you know, legal experts. So if you don't understand a term that's presented to you, you know, reach out, speak to your advisors, speak to, you know, your legal team if you have a legal representative, speak to other co-founders, right? I've seen it a couple of times now where people have signed up and they were so thrilled that they were getting their Series A deal off the ground and got their full, you know, valuation and the full round complete, that actually, to Darko's point, they didn't pay that much attention to the fine print, and further down the line, that brought up some very painful realities. So, you know, again, just make sure you understand the terms that are presented to you, and use your network and your advisors to make sure you understand what they are.
Brilliant. That's very practical advice. So thank you for that. Moving on now to kind of building relationships. So, you know, we talked before we started the panel, we talked a bit about this actually, but, you know, we're aware that with the pandemic, there's been a reduction of what we might call like organic networking, which means investor meetings are now all remote. But, you know, maybe coming to Darko initially, like in your opinion, how have the remote setting, the online meetings changed the ways that startups network and engage with investors? And how's it changed for you during the pandemic?
It has changed. I truly believe that, particularly at early stages in a business, the single biggest factor in the success is the relationships that the founders already have, or the board advisors that they've brought on that have, because it can significantly accelerate conversations. And, you know, if we think of businesses as beautiful organic constructs where, you know, the contracts that sit between different entities underpin the relationships to get to those contracts, and therefore ultimately the valuations is underpinned by the relationships that the founders can build very early on. Unfortunately for some people, you know, coming out of university, having not had exposure, or like coming out of first-time jobs or whatever the case may be on their first founding journey, they may not have some of the advantages that the later stage founders have with established networks. So I think that's one big difference between, you know, certain founders that we worked with, you know, that have had careers over the past 10, 15 years and have developed huge amounts of relationships versus some of the earlier stage founders that don't have that advantage. The random walk is beautiful, and certainly my career has been largely predicated on the relationships that I've built as well. And there is an advantage to doing these things digitally when you do have access. When you don't, I guess particularly looking at things like LinkedIn approaches. What not to do, I suppose, is when people approach you and they haven't done the research. You know, when you're getting 20, 30 emails or LinkedIn messages a day, if people haven't done their due diligence on you and haven't personalized those messages, you're much less likely to respond to them. So I guess the first bit of advice is just put in a bit of effort, make them personal. Don't do massive blast outs, like especially if you really want to speak with someone. You know, make it humble, make it personal, make it quite directed at that individual. And then in terms of comms, you know, I'm a bit of a time Nazi, so I don't mind 30-minute meetings, but there's a lot of context that's lost on Zoom. You know, you're losing 90% of the non-verbal communication. Things can get lost in translation. I think people are bored of sitting on these types of calls. Of course, not this one because it's wonderful, but as a general concept, I think people are quite looking forward to getting back face to face. That will certainly help. But there are positives as well, which is, you know, time, focus, and execution as well. So there's positives and negatives to both, I suppose.
And I guess there's a question to both of you really, but you know, from a startup or a founder perspective, is it good practice to seek advice as well from peers that you're working with in the same sector or a business that is at the same stage as you?
Yeah, without any doubt. Absolutely. And this comes back to my point around networking, right? Your network is so important, and you've got to work on that continuously. And to Darko's point, you know, if you're approaching potential founders, just sending a generic LinkedIn kind of, you know, request, it's just not good enough. It just, you know, people just ignore it. You have to do your homework, and you have to make it personal and make it resonate with the individual. But absolutely, yes, without question, networking is key.
One more point, the lost art of the call. Just pick up the phone and call someone. You know, why not?
Yeah.
Fantastic. Thank you both. And going to kind of the corporate partnership element. So, and Nick, maybe for you this question, but how do corporate partnerships provide growth opportunities for startups?
So this is one of the things that I've come across time and again, and there's some interesting learnings and scars on that particular journey. So clearly, when we're talking about fintechs or insurtechs, for example, who 9 out of 10 want to do business with the large incumbent, but that's very much a double-edged sword. And I would argue that if you are at the very early stages of your startup, I would tend to park those conversations for much later on, because you can do a merry dance with a large incumbent and run out of cash before they've even signed anything. So I'm being slightly facetious, but don't be over focused on doing business with the, you know, very large players perhaps in your market. That for me is a conversation that happens a little bit further down the line. if you do, then be prepared that these large enterprises will have pretty specific requirements in terms of what they are looking for. So you need to be very clear on your tech stack, security, your corporate governance, your communication, all of those aspects. You need to be really, really well prepared. Absolutely, there are some fantastic opportunities, and I would argue, actually, I don't know, Amy, if you concur with this, or Darko, but over the last 2 or 3 years, I think the banks, certainly the banks that I've been involved in terms of looking for opportunities, have done a lot in terms of being able to accommodate fintechs and actually structuring their whole engagement piece for that to be much better, because in the early days, 7-8 years ago, that was potentially a minefield and extremely onerous. I think most of the incumbents now have a much more easy to navigate path, and most of them actually put it online in terms of what their requirements are.
Absolutely. Darko, what are your thoughts?
I'm going to answer the question slightly differently. So I'll look at it from a couple of different prisms. So from an investor perspective, so if you look at corporate venture capital, that's largely been reined in over the past 12 months as corporate profits have reduced, but that may change this year. I'd say particularly for early stage companies, stay away. The reason is you're likely to get bad terms, get nowhere. They tend to invest in later stage businesses. So probably a waste of time. Good to get on the radar, but probably a waste of time. As a client, brilliant. Join an accelerator. Get the logo, get the proof of concept. Absolutely, yes. For deep tech startups as a potential licensee type of model. So we don't need to talk about specific examples, but if there's the opportunity to test a technology, particularly one that isn't quite market ready or requires additional regulation or licensing or specific insurances, absolutely yes. But just be wary that big companies also steal things occasionally. I'm not throwing any specifically under the bus, but just be very, very careful. Take your lawyers in the room. And in terms of acquirers, absolutely. So if you're ready or planning for some kind of trade exit in your slightly later stage, over 90% of businesses, they don't IPO. They tend to get gobbled up by larger businesses that are acquiring specific capabilities. So just to loop it around, I mean, there can be an interplay between those dynamics, but certainly from a client or an acquirer perspective, absolutely yes.
And Darko, just staying with you for a minute. So do you have any tips on identifying the most meaningful corporate partnerships and relationships? Talk
to them. Find out what floats their boat. Ask lots of questions, but don't get lost in the mire, because as Nick pointed out, you can have innovation departments or VC departments or corp dev departments or all kinds of lofty titles with people that need to make decisions. It can take a lot of time and resource. So just don't put all your eggs in the basket, I suppose, in one basket would be the advice.
Okay.
Yeah, but perhaps to just build on that point, because I think it's a really important one that Darko's just highlighted. If you do engage with a large corporate, make sure that you understand who your key sponsor is, right? Who's the person within that enterprise who's going to put themselves forward to back your particular venture, right? And again, as Darko said, there's so many different departments and everyone wants a bit, of you and thinks, oh, that's super exciting because you're the shiny new fintech. But actually really understanding when things get tough or when hard decisions have to be made, who's the key sponsor that is on your side, and identifying them and building strong relationship with them is, I think, really, really key.
And Darko, you mentioned earlier about accelerator programs. So how can a founder determine what accelerator program is right for them?
Well, there's generic and then there's industry specific. So, there's plenty of well-gestated e-com, fintech, and SaaS examples out there. If you look at sort of trends industries, some of the big banks, as Nick pointed out, have some fantastic accelerator programs. In the SaaS world, you've got Microsoft and Salesforce and others that are running some vertical specific examples. In the e-com space, we're seeing Shopify and BigCommerce and some of the big platforms that are running accelerators now as well, to identify early stage promising future partnerships. And then you've got the sort of more generic examples like your Techstars, level 39s, of course, and others. So it really depends what you want to get out of it. Not every business needs to go through an accelerator to be successful. I'd recommend accelerators mainly to founders that haven't been there, haven't got the badge, haven't got the network. Could certainly gain a bit extra through exposure. And the other thing worth mentioning is some of the VCs are definitely adding a bit more value in that context now as well. Creating better communities, venture support, etc. So you don't need to do it multiple times. Pick a couple of parts and don't waste too much time on it unless you're getting a huge amount of value out of it.
Brilliant. And what comes with a lot of those accelerator programs are access to mentors, and we certainly see at Level 39 that our mentors not only are hugely valuable but also become kind of effective navigators within their respective organizations, which of course can be hugely beneficial for startups seeking introductions and understanding the kind of engagement process. I guess my kind of final question really is around mentors. So Nick's one of our mentors at Level 39. So I'm going to ask you initially, what do you see for a startup as the main benefit of having a mentor?
Well, I'm slightly biased, but I do think that actually it is a useful resource to for startups in particular. And this comes back to your earlier question, Amy, around how do you prepare for and what do you need to prepare to go out to market and raise investment. I think it's recognizing what you don't have, right? So what skill sets are you lacking and how can you make up for that? Again, if you can get a mentor in to help you navigate that or perhaps address that, so that can be through strategic advisors or external board members, I think that's hugely important and useful. In particular, again, as Darko said, if you're relatively early stage startup and perhaps you haven't got that network yet, then tapping into mentors who do have network and do have some of that experience actually is really, really useful and valuable. But I'm hugely biased. I'm more interested in Darko's view on this.
Sure. So I think there's the business, but then there's also the person, i.e. the founder. No one has all the answers, and being a founder or a C-level exec in any business can be quite lonely. Leadership can be lonely because who do you go to when you've got problems? So I've personally found a huge amount of value in having very direct mentors, not just for the business but also for me personally. So they can fill certain gaps in knowledge, be a reference point, help problem solving, particularly when it comes to staff strategy or otherwise. Just getting a reference point from someone that doesn't necessarily have a huge amount of vested interest in the business has a huge amount of value. In terms of the business itself, I guess the advice, just echo what Nick said, would be if you're going to build a board of advisors or a board of mentors, make it functional. So define those functions and fill the gaps that you don't currently have. I would always set KPIs. So just because someone's nice and likes you or is invested in the business, that's great. But if they're going to get stock in the business in particular, make sure that they're beholden to outcomes. That would be a strong piece of advice. And that could be things like access to capital, sales, or otherwise. And then just one slightly, I guess, negative point, just a personal bugbear of mine that I just wanted to raise. There's lots and lots of advisors out there, or purported advisors, that have never run businesses in their own right before. You know, they've had big, lofty corporate titles, but haven't actually ever run a company, and are selling themselves as these, you know, experts in early stage companies when really they're let's be honest, maybe bored fat cats of some description. So having that having those accolades is great, but it might not always be practical in a small company environment, and especially if they're asking you to get paid before you're making revenue. That is a big red flag. Not to end it on a low note, but just caveat emptor.
I have one kind of final question on the kind of mentor point. So, you know, a number of times mentors can actually move to, as you mentioned, Darko, you know, more of a kind of formal advisory role. How does a startup manage that relationship? How does it go from kind of just a mentoring function to more of a formal relationship?
I can take this one, and I'm happy for templates with anyone that wants to do it. It's good to formalize these things. So you have board advisory or fast agreements. So it just sets the expectations and the onus on the business and the mentors or the advisors around those KPIs and the expectations and the role that they're filling. I think that's very important to document, particularly if things get contentious down the track. You know, you've got a measure of success. I think that's one aspect. In more mature companies, once you start getting to, you know, more formal board arrangements, I do advise our businesses to actually put in place proper, well, not just directorship documents and the relevant governance around that, but also if they're paid directors, to have actual agreements with those directors as well. And then there's all things that encompass that. But get it documented, I guess, is the advice.
Brilliant. Thank you. Nick, any final points from a mentor perspective?
Yes, again, I've been through this journey a couple of times now. And as Darko said, I think the key thing is having a very clear understanding about what the role that the advisor then takes is, and documenting that. And as Darko says, there are, you know, plain vanilla term sheets and templates out there that you can use. That's absolutely key. And just making sure that, you know, just because someone's been a good mentor in a particular stage of your journey doesn't necessarily mean that they're the right person to scale your business up, right? So being very critical around what that person actually delivers, right? And what their skill set is that they're bringing to the table, that's key.
Great. Thank you both so much. So that, given the time, is the end of our kind of panel discussion. So thank you both so much for taking the time. Just seeing if we've got any audience Q&A. I don't actually think we do coming through. So what we can do, as a reminder to everyone watching, obviously, as soon as we kind of end the presentation element, you can actually then go back to the effectively like kind of virtual networking tables. So feel free to stick around and obviously, you know, meet Darko and Nick and obviously meet each other. So again, Darko, Nick, thank you both so much for joining. Really appreciate it. It's been a pleasure having you here. So thanks for taking the time. And yeah, I think everyone else, stick around if you can do, meet one another, and we'll see you again soon. Thank you.
No worries. Nice to see you. Bye.